here's an outline of where all we're going tonight. We'll start looking at the corn and hay situation, transition a little bit into the cattle cycle and what our supply expectations are. And then we'll look at a little bit at the economy and what that means from a retail meat demand standpoint. And then I'll turn it over to Terrell, and he'll take us through a little bit more of the wholesale meat side of things, as well as our 2026 cattle market outlook, along with the calf and female discussion. So with that, looking at our WASDE report, this came out last Monday, and there was a few surprises here. One of the big ones was that they increased their basically all of the corn production metrics. So it started with increased corn planted acres, and where the big increase was noted was in that percentage of harvested acres. So they jumped that up to 92.3% harvested acres. And along with that, so we increased our acres, and we also increased our yield to a record 186.5 bushels per acre. You can see that here on this chart below. And so that resulted in record large corn production, just above 17 billion bushels, and so well above the previous record in that 2023 year. So again, huge corn supply as we enter into the new year. And so with that, yes, the government can come out and make further revisions to the supply side of things, but typically they're very minor revisions on the supply side of things. We can likely expect a few more changes on the demand side. But as they came out in this report, saw an increase in feed and residual usage. And then also here in 2026, we're expecting record corn exports. So again, while we're increasing our supply, we're also increasing that demand. And so while stocks to use did increase 1.1%, it's still in a very comfortable 13.6% in a stocks to use ratio, with ending stocks now at 2.23 billion bushels. And looking at that from a price standpoint, markets did correct 25 cents last Monday when that WASDE and crop production reports came out, but still leaves us at 422 today. So still very comfortable in terms of prices, very attractive if you're a corn buyer and user. And so this is translated to ration costs at around $1.05 to $1.10 cost of gain. And really, you can see here in the last couple of years, we've been in a pretty decent trading range as we've increased our overall stocks to use ratios compared back to that 2021, 2022, early 2023 time period. And as we look at this year ahead, we think we'll be in a range of $4 to $5. It shows that here, range of $4 to $5 with the forecasted average around $4.50 this year. So a little bit higher than last year, but not by much, only a few cents higher. And so again, from a corn standpoint, we're in a decent shape. We've increased our supply, but we've also increased our demand, and it still leaves corn at a very comfortable price level compared to some of these historically high price levels. Transitioning over to the hay side of things. Not a lot changed in 2025 compared to the previous year. We did increase our harvested acres just a little bit, but overall hay yield remained exactly the same last year. And that left us with production that was just a little bit bigger than in 2024. When we think about that from an ending hay stocks standpoint, again, just a touch above 2024, and this leaves us the largest hay level since 2020 was the last time they were higher than this. And so we've gained a little bit more hay, or we've built up a little bit more hay. And at the same time, prices also dropped another $15 in 2025. 2024, we averaged around $175 per ton for U.S. all hay prices. In 25, that was closer to $160. And as we look ahead to 2026, we do expect to have similar yield ratios and probably get a few more acres. And so we expect that to soften hay prices just a little bit more, likely $5 to $10 softer, which would put us around 150, say 155 per ton for hay. Along with that increased supply, though, we've also increased our demand somewhat. Both on the, or as we look ahead, both on the beef cow and dairy cow side of things. That's particularly true in the dairy cow side. As we've grown those numbers here in the latter half of 2025, we can see that metric or that show up in our hay stocks changes from the May hay stocks report to the December hay stocks. We had pretty large usage of those stocks, and a lot of that came or likely came on the dairy side of things. This just shows that seasonal price trend across time or across each year. Typically ramps up and is largest kind of that late spring, early summer time period before we start harvesting. Again, you can see we're ending the year or ending 2025 right at $100 or $150 per ton. Expect start January just a little bit below that before starting to increase a little bit seasonally. But again, very comfortable prices there. And this just shows that relationship between monthly hay and corn prices. Again, they typically trend together. And I say that we are calling for a little bit softer hay prices this year, with corn prices being slightly firmer. But again, as we've increased these supplies, we've also increased that demand at slightly different levels. So as we take all of that, we want to shift gears a little bit and kind of step back and look at the overall beef cattle cycle. And so when we look at this, this is basically a supply and demand chart. And so as we look at this, we think about this, when harvest numbers, fed harvest numbers start to decrease, prices subsequently increase. We're at a point now where we've had record high cattle prices for all classes of cattle this past fall. And we're seeing sharp reductions in fed slaughter. Despite that, we have yet to see much of a response yet on that cow inventory side of things. We do think we'll start to see a little bit larger numbers here beginning of January 2026. But again, it's been very lagged of a response. So what that means is that it should support us in maintaining a higher price range looking ahead into the upcoming year. I know Terrell will kind of talk us through a little bit of that, what our price expectations are for this year, and just kind of in the grand scheme of things. But again, this slow rebuild should support us maintaining a higher practical range than what we've seen in the previous cycles. As we take that, this just takes that cow inventory number and applies it over the last 75 years. And you can see that really over the last 50 years, cow inventory, so this is both beef and dairy cows, have trended sharply lower, but at the same time, we've been able to not only maintain, but increase our beef production. And that's a lot of different ways we're able to do that, increased weights and animal husbandry practices, better utilization or incorporation of the dairy industry, and then technologies at the feeding level, such as Experior and some of those other beta agonists and similar items. And so when we think about all of this, this has been really important for us to help maintain large beef supplies, or at least adequate beef supplies, to meet that strong consumer demand for beef. And so when we think about that, we're right down here, and as I mentioned, we expect to see a little bit more or a small increase in terms of beef cow numbers here at the beginning of 2026. But what does it take to drive that? What does it take to turn that corner? There's a multitude of factors there. First off is the cash or the financial side of things. We've had that cash incentive for the last 2 years, 3 years really, with these record prices continuing to trend higher. So the economic or financial motivation is there. We've just been waiting on Mother Nature to cooperate. We have yet to see large supplies of green grass available for these areas or for a lot of producers. Now, we did see some of that this past year, and it's a little bit more on a regional basis, but again, we have yet to see widespread, nationwide abundance of moisture leading to increased pastures. We also have to recognize that there's some limitations or some factors holding us up first off is just interest rates, which have come down a little bit over the past 12, 18 months, but they still remain relatively high compared to where we were at 3, 4, 5 years ago. We think about higher interest rates on top of larger input costs. The financial capital required to expand the herd is huge at this point in time, and so that's a limitation right there. Labor and the age of producer, average age of producer, has been a ongoing discussion point for the last 10, 20 years. Nothing's changed now. We're seeing some producers have taken advantage of these increased cash prices and identifying that as a good point to go ahead and just start to slowly get out of the business, not retain any additional heifers, and slowly start to kind of lower their work burden. One of the big things that's really playing a role right now, or over the last 12 months or so, is just market volatility and economic uncertainty. We've seen some pretty impressive swings in prices here over the last 12 months. And there's a lot of what I would call external factors creating additional uncertainty in our markets. And I say external, a lot of that comes from government policies related to New World screwworm in Mexico and shutdown of the southern border. And then also items such as, say, presidential tweets on beef prices and how that creates some additional panic in the marketplace that we have to deal with. And then finally, there's a memory of that decline in 2015 and 2016. We had that sharp run up in prices in 2014 and 15, and then we turned the corner and just as quickly fell back down. That being said, we're in a different supply situation this time, which should help limit some of that. But again, people are a little gun shy. They're a little cautious because of that. So as we move ahead, we think about, I mentioned grass is still a limitation. This is the most recent drought monitor from last week. You can see we've still got quite a bit of drought here, particularly in southern Texas, southeast, and then moving up through the Corn Belt. If you compare this back to, say, the same chart a year ago, we have improved in some areas, such as southern New Mexico. I mean, it's still dry there, but better than it was a year ago. And particularly up here in Montana, Wyoming, Idaho, less drought there. But that being said, if you take the drought metrics and you apply it across our beef cow herd where it's located in terms of states, we've got around 48% of the beef cow herd located in drought impacted areas, moderate or worse drought impacted areas here in December. And so that's up from where it was last year. And it remains a challenge. Now, I do feel bad talking about droughts. I know this panhandle region and then up into the Corn Belt is about to get slammed with a winter storm later this week. So that it'll be a rough 24, 48 hours there, but that should create some additional moisture, bring in some moisture that will be really, really critical, especially for some of the people with wheat turnout. That'll be really helpful there and hopefully gives us a little bit of moisture to kind of get us through into the spring time period. So yeah, certainly want to recognize that. And then as we start to look further ahead into that spring, summer time period, Matt Makins of Makins Weather put this chart together for us, and this is just our ENSO predictions or probabilities of transitioning from that La Nina phase where we're at now in January. So as we move into the spring time period, we'll increase the odds of transitioning into an ENSO neutral time period. And as we get later into the summer and into the fall, we're predicting transition from that neutral to more of an El Nino weather patterns. And so historically, that means increased moisture and a little bit cooler weather, particularly in the southern plains. So now I know this is showing out the next 12 months, and so it's tough to really rely too heavily on this. But one of the big factors driving all of this will be how quickly we transition from that neutral into that El Nino time period here in that summer time frame. That'll dictate how much moisture we get, how much grass we're able to build up. So as we take all that, we start to look ahead at our some of our supply numbers, and we'll start with our beef cow inventory. So here at the end of the month, end of January, we'll get our cattle inventory report from the USDA. And that'll give us our final supply numbers with what we started 2025 at, or 2026 at, excuse me. And right now, our predictions or our forecasts are that we'll increase our beef cow numbers by around 180,000 head. So not a huge increase here this next year. Really, the next 2 years, it's going to be minor increases. And a lot of this is mostly from, or can be attributed to, decreases in non-fed slaughter, decreases in that beef cow culling rates and beef cow slaughter levels. If you look back in 2024, our beef cow slaughter dropped 19%, dropped 19% in 2024. 2025, that number was down 18% from the previous year. So again, we've drastically reduced the number of these animals that we're culling and harvesting, and so that should translate to larger beef cow numbers. On the flip side of things, we have yet to see much in the way of retained beef replacement heifers. As we look at this, we are expecting to see a jump here in the beginning of 2026 of females retained out of this past year's calf crop, but those really won't translate or turn up in the beef cow herd until 2028. So again, very slow rebuild on the heifer side of things. And we can contrast that back with the previous cycle. If you look up here, that beef cow low was in 2014. We had already been keeping heifers back for a couple of years prior to that. And so when we hit that price explosion in 2014, we were primed and we were ready to rock and roll and drastically increase that cow herd numbers. That's not the case this time. Again, we've been keeping or retaining less heifers all the way through here. Now we do expect that to change in 2026, but again, that's a very slow transition there and creates much more of a U-shaped or saucer-shaped bottom compared to that previous cycle, where it was a very sharp decline followed by a very rapid increase. Thinking about the dairy industry, they're doing the same thing. Really, the middle of 2025, they started growing their dairy cow inventories or dairy cow herd, and that was primarily through retaining or keeping back some of those aged females and trying to get an extra lactation cycle out of them, trying to get an extra calf and milking period out of them, and less on the dairy heifer side of things. The dairy industry suffered poor milk margins from 2020 through middle of 2024 before it started to turn positive. And so they have a lagged period with how heavily they've adopted some of these beef sires within their breeding systems to produce their terminal offspring. They'd relied or built so heavily into that they were just behind the eight ball in terms of having enough dairy replacement heifers in the system. That's starting to change. We'll see a few more dairy heifers out of this year's cattle inventory report. But right now, again, they've been able to kind of grow that or rebuild that dairy herd side of things through some of these aged females. So when we think about all of that and we apply that to steer and heifer slaughter, we have to recognize that both the beef and dairy industries are in the process of pulling heifers out of that fed slaughter mix. On top of that, reduced inventory or reduced bred female numbers has left us with, or is in the process of leaving us with sharp declines in our fed slaughter levels. Right now, we're looking at 2026 being the low in fed slaughter, but that's also relying on the Mexican border, the southern border reopening to imports of feeder cattle sometime in the first half of 2026. If that doesn't occur until later in this year or even 2027, then all bets are off, and 2027 will likely be even lower in terms of fed steer and heifer slaughter. And so talking about the Mexican situation, we have to recognize that this is a big unknown. There's still a lot of factors at play here. I mean, we had the report just last Friday, of additional cases of New World screwworm detected in northern Mexico and Tamaulipas, so again, closer to the U.S. border. And then there's a rumor of screwworm in the United States. That was proven to be false, but again, that creates additional uncertainty and likely further delays the reopening timeline of that border. And so when we think about this, right now we're targeting that April, May time period for a border reopening, but there's still a lot of factors at play here that could push that time period a little bit further back. But what we have to recognize with that is even if we reopen that border, say April 1st, the weights at which we typically bring those animals across, historically, 98% of those animals that came across weighed less than 700 pounds. As we got into here in 2025, we reopened the border for these few months, and then again for a few days in July, we did increase that percentage of heavier animals, but a lot of those animals that come across historically have gone on to grass for a little while before going into the feed yard. But even if we adjust that supply and we bring in some heavier animals that go straight into our feeding system, it's not likely that we'll get back to a steady supply mix in terms of fed slaughter at roughly, say, that 20,000, 25,000 head per week until early in 2027. So the further we push that border reopening back, the further we're pushing back this increase in steer and heifer slaughter. And so Tara will talk through a little bit of the price implications of all that, but again, this remains a big unknown that going to play a big role in our overall supplies. So when we think about that, we think about our domestic situation. One of the ways we've been able to counteract those decreasing fed supplies is by feeding these animals for a longer period of time and adding additional weight to them. Now, again, I mentioned beta agonists and items like Experior helping improve these carcass weights. That can certainly be seen here in the carcass weight data. But again, the cost of gain is just such that really motivates cattle feeders to add as many days as they can without increasing their late day death losses. And so as we've looked at this, 2024, we added 27 pounds on average for cold carcass weights. In 2025, we added 22 pounds. This year, we're looking at adding another 9 pounds to the average animal. This has made up quite a bit of our declines in fed slaughter. 2025, that added or increased 22 pounds was the equivalent of 800,000 head at these weight levels. As we start to look ahead, we'll probably get back closer to that long-term average increase of around 4 to 5 pounds per year, particularly as we start to bring back in more of these Mexican feeders. They typically finish at lighter outweight than our native steers do. And so that's why here in 2027, we've got a much smaller increase going ahead. And then here in 2025 and 2026, as we work through a lot of these supplies that have come across, and we have less Mexicans in the fed system, that's been another factor helping us drive some of these heavier carcass weights. And as we think about this too, I mentioned adding days on feed. Compare back to where we were at in, say, 2000, we've added 40 days on feed for an average native steer. So again, as we've been able to make genetics improvements or changes to these animals, and again, feed them to heavier outweights, we've been able to better take advantage of that genetic potential by creating more beef with less animals. So as we look at all of that, here in 2025, or this past year, 2025, we saw roughly 1 billion pound decrease in terms of commercial beef production. So this was a combination of tighter fed supplies and particularly tighter non-fed slaughter levels. Expect the same thing to occur in 2026, and our increased weights are not enough to offset, again, these declines in bodies. So as we think about that, one of the ways, or an additional way we've been able to kind of counteract some of these declines in our domestic beef production is through increased beef imports. So you can see here that 2024, we added around 24% total to our beef imports. 2025, we added another 20%. Here in 2026, we're looking at adding a little bit more. Again, it's to be able to counteract or offset some of our declines in our domestic beef production. Now, with all this, we have to remember that the vast majority of what we import in terms of beef is a lean trim product that is really comparable to our non-fed, our cull, cow, and bull slaughter production. And so this chart shows that very well. It shows those trends in the non-fed beef production across time, and really how our import levels swing based upon the amount of non-fed animals that we're harvesting that year. So you can see over time, we've been slowly trending upwards in how much of this lean beef we want to consume here in the United States. To where really from 2000 up to, say, 2014, consumed an average or required an average around 7 billion pounds total combined non-fed and imports. 2015 through 2023, that metric jumped up to 8 billion pounds on average. And here the last few years, we're a lot closer to 9 billion pounds of lean trim product. And so we've talked a lot before about the U.S. being a hamburger nation. It's never been more true than today, and this metric clearly shows that. So as we think about our per capita net beef consumption, the U.S. consumer clearly demands between 57, 58, and 59 pounds of beef per person per year. So again, that's what they require, and the markets will go out and find that product, oftentimes through increased imports. I mentioned us being a hamburger nation at this point in time. Within this 58, 59 pounds that we're consuming, over 54% of that is in the form of a ground product, some form of lean trim product. And so again, it's really important to us to be able to maintain these import levels to continue to provide beef to our consumers at a slightly lower price point than, say, our steaks and roasts. So again, we've benefited greatly from these increased imports here the last few years to be able to meet that consumer demand and continue to provide them a beef product, preventing them from switching to, say, a competing protein. And so as we take all of that and think about some of the different factors that have supported the consumer demand for beef, a lot of it starts with our economy. And so far, our economy has performed very well. We've managed to shrug off any fears of a recession. And that's both at the consumer or individual level, as well as, say, our stock markets and hedge fund managers for the most part. Bank of America, for example, does a survey of hedge fund managers, and for January of this year, hedge fund managers and commodity brokers were extremely bullish for the U.S. economy. They had record low cash reserves, meaning that most of their funds were tied up in commodities and stocks. That being said, over the weekend, we did have some turbulence in the stock markets following some comments from the president on just international affairs and approaches to Greenland. And so we have to recognize that there's some uncertainty here within the economy there. Now, were the stock markets, did they maybe have a little bit of air built into them? Yes. Is it also a mid-cycle election year, which creates additional turbulence there? Yes. But we have to recognize that this does serve as a little bit of a cause for concern, or at least something to pay attention to. But as we think about the rest of our factors, unemployment has maintained very decent levels. U.S. GDP is continuing to chug along. Interest rates are continuing to slowly drop. And per capita disposable income continues to maintain the upward trend. So again, all of these factors support a very healthy U.S. economy, which translates to consumers having disposable income that they can then turn around and spend on our high-priced beef. So within that, 2025 U.S. all-fresh retail beef averaged around $8.84 per pound. It ended the year at $9.55. December's all-fresh beef came in at $9.55. And we're at a point where we're starting to be concerned about consumer resistance. I mean, really, the entire way up the past 12, 24 months, every time we see an increase in retail beef, we have to ask ourselves, is this the point where we'll start to see some consumer resistance, some consumer pushback, leading them to transition to some of our competing proteins? That has not been the case yet, but we think we're starting to approach that level. We think this 950 mark will serve as a minor resistance, and we have to, with our limited supplies, we have to push consumers to competing proteins just on a minor level. We don't want to completely run them off, and we don't think that's going to happen based on just how strong our demand has been. We look at our change in prices relative to our change in supplies. Consumer demand has been incredible. And by creating these, or through the consumer paying for this increased beef prices, that creates more margin in the system that can be transferred or shared throughout some of the different production sectors. So again, really strong demand levels. You can see that here compared to our, say, composite pork retail prices and composite broiler retail prices. If you just look over the last few years, look how much beef has increased compared to pork, which has been mostly sideways. And then broilers, composite broilers have actually trended a little bit lower. They overshot the runway somewhat in 2022, and they're still trying to get back that demand. So again, record demand in terms of all fresh retail beef. Now, as we look ahead at 2026, we do think that we'll still average higher on an annual basis, but in the latter half or second half of 2026, we think prices will maybe start to soften a little bit. Part of that is seasonal, but part of that is also just some of that consumer resistance, forcing them to switch a little bit more to some of these competing proteins just due to us not having enough supplies to be able to meet that demand at a cheaper price point. So we think about all of that, and we have to recognize, again, that's been our consumer demand for beef has been propped up by the economy, but it's also been directly due to increases in our prime and choice grading percentages. This has continuously been one of the number one factors or determining metrics for consumers and why they prefer beef is just our ability to provide high quality, delicious product. And again, this comes back to our increased technologies and increased breeding decisions, conscious decisions on the fact of, or in the mind of producers to select for animals that have better carcass merit and higher quality grades. So again, we've increased over the last, say, 20 years, we've increased that percentage of prime and choice grading product by over 50%. So again, very critical to the success we've seen here across the last 20 years in developing that consumer demand for beef. So with all that, I'm going to turn it over to Terrell. He'll take it away from here. All right, I can see your screen, Terrell.
Excellent. Well, I thought Matt did an awesome job there laying out the big picture fundamental story that we're looking at as we get into 2026. But I think the core story is obviously that supplies are still very friendly, at least here in the near term. When we think about our domestic supply, the turn to this cycle is much slower than what we maybe experienced in 2015 to 2016, 17. And ultimately, that from a supply perspective is supportive to price and also supportive to us from an overall industry standpoint. At the same time, there's a lot of volatility in this market as well. And that's been something that obviously we've seen the adjustments both to cash fed cattle prices, the futures complex, and that's more the uncertain factors that Matt illustrated as well. Mexico, in my mind, is the biggest what if, and it changes the fundamentals one way or the other depending on one policy decision. And I just want to spend a little bit of time here up front going through the differences of what the market's kind of priced in and kind of what our vision is for 2026. Just kind of even starting back into the summer, I think you have to initially go with where we were back there in about July of 2025. And that's when we initially opened the border back up and then closed it rapidly right back down. And that was really a catalyst for the market. Maybe not as much for the cash side of things, but that right there, in combination with the additional tariffs we put on Brazilian beef, essentially put $30 on the futures through that time frame. We rallied from about 215 to about 245 to 250. Then as we've come through here and got into October and ended up with looking like we were going to have that seasonal rally, well, that time dried up with beef making the headlines and a lot of speculation, frankly, around what was going to happen with the border, tariffs, and then kind of coming to a head with the loss of packing capacity as well. So in the course of from October 16th to essentially November 24th or 25th, the market priced in two very different scenarios. One, basically a 250 average for the fed cattle market. The other, basically a 205 average. In my opinion, both were probably too extreme. And we do finally have a little bit of clarity, at least in regards to the tariffs on Brazil. We know that those are off, and we are going to be bringing in Brazilian product. So strictly from that perspective, is that maybe going to prevent us from getting quite so high at the top of this market, even though we've recovered? In my opinion, it may. And we may not want to be looking for, at least in our opinion, I'm not looking for the market to go off and make substantially new highs from what we've already seen. We'll go through that here in a little bit. I think the bottom line, though, is we have to acknowledge that this is still going to be a volatile market in 26 because we still face those headline risks with, is the border open? Are we going to get screwworm here in the US? And we have to anticipate, or at least expect, I should say, the market is going to react to that and likely either price in the worst or the best of the news in very rapid fashion. So this is a market that, if everything goes well, the fundamentals are very favorable to us from a cattle industry perspective. It looks very solid in terms of beef demand, very friendly in terms of domestic supply. But there's some big changes that can occur at the drop of a hat if that policy decision gets made. And just breaking that down, I think it's helpful to look at what is that actual impact on the market. We talk a lot about it. What are these different factors that have been influencing things? The Mexican border we've covered. Essentially, 1.2 million cattle got evaporated out of the system, equating to around 1.1 billion pounds, 1.04 billion pounds of product to our domestic market. Well, that's supportive. When we take that supply out, it's kind of a shock to the system. And that's been a positive to us of plus $18. When we had the tariffs on Brazil, that's also positive to us from a supply perspective, right? Takes around 800 million pounds out of the market. So you had $12. I mentioned earlier on that chart what happened when both those factors got into play, right? We closed the border in July. At the same time, started to talk and put tariffs on Brazil. That's where we went from a 215 market to a 245 market. So pretty dang close, really right in line with what the expectation would be with those two factors from a positive sense to the market. We also ended up peaking at about 250, and then we had the other news that ultimately we don't believe from a fundamental perspective this was the main driver of the break. The reason being getting the access, the increased access to Argentinian beef, even tripling their quota from 20,000 metric tons to 60,000 metric tons is a lot of pounds. 132 million pounds in its own right is a lot of pounds relative to these other moves, relative to our market that's producing 24, 25, 26 billion pounds of product. It's not as big of a market mover. In fact, when we look at it in terms of the price, if we were to add that product in, it'd only take about $1.50 off the market. And even today, as we speak, that official quota really actually hasn't been increased. Their quota is still at 20,000 pounds. But if you do hear that, if they were to open that up this year, that's not a big risk to us in terms of a pure price perspective. These two, Mexico and Brazil, were much bigger drivers. Now we know we are going to get this product from Brazil. From a fed cattle standpoint, does that give us with a little bit bigger supply and maybe limit our top side potential a little bit? It does. But at the same time, can we still see a market that performs very well, averages steady to higher than a year ago? That's still our expectation, pending what happens here with the Mexican border. The other things that we need to watch, one is there anything going to happen with Chinese beef exports? Are we going to get access to China? I should say, our exports to China? They have updated their tariff rate quota system, but there's still no reinstatement of our export licenses. And really that's the linchpin. We need to either regain access through getting those plants reinstated, and that would be a positive to us because now we're talking about around 450 million pounds of product getting off our domestic supply, leaving the domestic supply. So that would actually add some potential back to our market if you were to see this happen. As of January 1, there's really no sign of that, and nothing that really at least in our opinion, that says that's imminent this year. If anything, maybe the second half of the 2026. The other question that we'll talk about is, well, what was the impact of the Tyson plant closure? Because what happened when we ended up with all the speculation around beef prices, right? We were basically sitting at 250. We undid the $30 we added in, and then ended up at a low, basically back at 205. So you took the $30 right back out, that the market was speculating that the border was going to reopen, that the tariffs were going to come off Brazil. And then at the very end of it, we have the impact to leverage because we did shutter that capacity in Lexington and move Amarillo to a single shift plant. And from there, that's where the market built its base back. Basically right there, futures went down to 205, cash went right to 215. So the market was pretty efficient in adjusting to those different factors, but they're massive swings in our market. We hope the dust is at least settled on some things now that we have clarity around Brazil, clarity around packing capacity. The big wild card remaining is what will happen with the border. And as Matt highlighted, that's still a lot of uncertainty there. But I think what's important to realize is, depending on what happens, we should understand what the potential impact is to our markets. Now, the leverage impact, is it ideal? By no means is it, right? We go from 500,000 head of hooks, and that's where our leverage was exceptional in 2025. The biggest driver of this relationship, and when I say leverage, I'm talking about the share the cattle industry gets relative to those above it. So either share of the cutout, share of retail. When we have less cattle than hooks, that's good for leverage. And we're still in a state where we are expecting to have fewer cattle than we have hooks to harvest with. But are we going to see as high of a percentage as we got in 2025? Probably not. That's going to be limiting a little bit to the market. But again, this is another key factor that's very different than the 2015-2016 cycle, because we're still at a state where there is less cattle than hooks. Again, Matt mentioned that was one of the fastest expansions in the history of our industry. And what happened? Well, we were shuttering capacity, and at the same time, we expanded into it very rapidly. As we retained those heifers, supply dropped, but as they started to produce calves, we found ourselves with more cattle than we had hooks to harvest with. That's where the impact to leverage is. So this shows that annual relationship between the fed price and the cutout. What year did we first see more cattle than hooks? It was 2016. That was the first year we got the drop in leverage, exacerbated by the COVID situation, right? Really happened at the worst time for us as an industry because we were at our peak in fed cattle supplies and didn't have full access to our 40-hour capacity due to COVID restrictions. Now you look at where we get to as supply and capacity rebalance, and it's an exceptional recovery in that relationship. But we're not going to be quite as strong in 2026, in our opinion, based off this relationship here, where we are back to having still less cattle than hooks, but a more in-line relationship. As we look at what's that mean to us in terms of the fed market, it still points towards an average that's essentially steady with year-ago levels. If you have a 370 cutout, which would be slightly higher than where we were, beef demand still holding together, supply still tight, and take that leverage metric at 57.5 and add in the drop credit, that equates to a market that at 225 is very well supported. Basically, prices even with year-ago levels, maybe even a tick higher if we end up with supply being a little bit friendlier based off what we've assumed, right? So all that looks positive. It's not going to be the same type of situation as what we saw coming out of 15 and 16. Now, if we were to say open Mexico up and think about 2027, and all of a sudden you do add 500,000 head of cattle that show up in 27, or 1 million head of cattle that show up in 27, we'll want to watch this pretty close, because that isn't just going to be a supply move. That's also going to impact this relationship between the amount of cattle and hooks, and could see leverage come off to a historically more normal level. So something just to keep in mind longer term. 26 still looks very good. 27, there's things that could change that may impact these assumptions. Now, where are we right now? You look at things from a placed against supply perspective, how many cattle have we estimate have been placed against the first half of the year? Still points very, very friendly supply-wise. You have less cattle all the way through relative to a year ago, really kind of peaking on a year-over-year difference in this March, April, May timeframe. And that's going to be supportive to prices, especially in terms of fed cattle performance. We've seen a pretty robust recovery there. This would suggest that through the first half of the year, we're pretty supported. Now, Matt highlighted it. What happens if we do open the border up in April? Well, do we start to place a few more cattle late against that time frame? But what if you push this back? That's more positive to us. That likely keeps the placed against supply a little bit tighter, a little bit longer. Bottom line, though, I would expect that we are nearing the low cyclically in fed cattle supplies. I would say it's likely 2026. Even if we don't open the border up, Matt said maybe 27 will be a little bit lower. I think that is fair. So, but at the same time, over the next 12 to 18 months, if we're starting to see that modest turn in our beef cow inventory, a modest turn in the dairy cow herd, that says that even though Mexico may not change, or if it doesn't change, we should still see a few more calves working their way through the system as a result of that stabilization in our beef and dairy herds. So both would suggest we're modestly turning the supply, at least domestically. The big wild card and the biggest marginal difference will be Mexico. But from what's that mean to us from a price perspective? And we'll start with the Fed steer price. I think it's important. To me, it's the real linchpin of everything, and everything else kind of correlates with it in a macro sense. You see the performance we've had since early 2022. It's been a remarkable run for this market. You've really seen cattle prices more than double in value since the COVID lows from low to high. And we're still seeing, again, that big increase on a year-over-year basis. I don't think we're at a spot where we're necessarily going to see fed cattle prices push very aggressively, but I think we'll spend a lot of our time in between this 230 to at the most 250, in my opinion. I think 245 is maybe a better barometer, but let's be friendly to the market if supplies work in our favor and demand still holds together. To me, that's kind of your top side potential from a leverage standpoint and from a supply standpoint. Still very solid, but maybe not a market that's going to be quite as directional as what we've seen here over the past several years, that we were kind of defining the upper end of the range in terms of that Fed price. If that's the case, that probably also says something similar about both our feeder cattle prices and the calf prices as well. I wanted to show this just for long-term perspective. Not only have we seen more than a doubling of prices for the fed cattle market, you look at where we started at $1.20, you've over tripled prices for the feeder cattle complex, right? All the way up to $3.80 at their peak. And they've recovered, had a scorching rally back up through here as we've gone and returned off those lows, off kind of that policy-induced panic there back in late 2025. Now, the question is, are we believing that we're going to continue to push these very aggressively? I think there's some limitations here. If you're not going to go off and make new highs in the Fed market, it's probably going to be a challenge to see feeder cattle prices make meaningful new highs as well. The other limitation here is just the price relationship between feeder cattle and the fed cattle complex. They're honestly relatively expensive. The feeder cattle are either relatively expensive compared to the fat complex, or if you want to be more bullish than that, the fat complex is too cheap. And we'll jump down here first to kind of show what I mean here. We're placing cattle right now, putting a one on feed at basically against a 230 live cattle complex, 230 live cattle futures. That's also basically right in line with the fat market as well. If the cattle feeder was to break even, he'd need to buy that animal between 330 and 340. But if we look at where we are today, market is 370, 360 to 370. We look at where they're going to need to be to break even. They're going to need a 240 to 245 market, if not even a 250 market at $1.05 cost of gain. That says right now that the feeders are expensive enough that it's making the cattle feeder kind of bet on the come. And it's very dependent on what is the Fed market performance. Well, if we don't start to see that translate, then our feeder complex may be at the upper end of the range as well. If you want to try to say, well, what would it take to get to those $4 feeders? Really, it would at least take the deferred live cattle making new highs or getting back to their old highs, and still making the cattle feeder bet on a negative margin, by a negative margin to get there. So in my opinion, there's probably going to be some resistance at this 380 area, at least as we go through the first half of the year. If we want to open up more topside, I think you have to wait and see what happens with the Mexican situation. Calves are very similar, have also been essentially directional and to all-time record levels as well, been a boon to the industry, and really the signal being sent that financially we need more calves, right? That's the tightest area of supply when we think about our industry as a whole, and those have actually gone off and made new highs here as we've got into the spring time frame. Not uncommon when we think about that seasonally as we start to approach grass season, starting to see these calves get picked up for summer inventory. And I would expect with pending news of what happens with Mexico, if that continues to get pushed further and further down the line, we'll still see a very, very robust calf market as we go through the spring time frame. Where could we have more risk? Well, you get out later in the year, is there potential that you get that announcement, or the market starts to sniff out that, okay, yes, we're at the low end of the cow herd, cattle supplies, fed cattle supplies, you're either at their low or going to start to turn higher, then maybe we start to see a little bit more resistance in terms of topside potential. But at the same time, still looks to be a very profitable year for the cow-calf segment of the industry. Moving into the bred cow discussion, we finally started to see those maybe catch back up with the market. They were a little bit slow initially because we were still limited by drought, and I think still needed more dollars in the system to start to finance buying some of these bred cattle. And plus, you look at higher interest rates through the early portion of this cycle, also I think limited some of the action in the bred cattle market. Where are they today? We'd have them estimated on average closer to 4,000 on a monthly basis, averaged an all-time record near 3,750 in 2025. They've gone through a big push, but would expect that as we kind of unfold here, yes, we should see better weather if we transition into the El Nino pattern later into 26. Calf prices should stay strong. Ultimately, that should leave your bred values very, very well supported going into the fall of 2026. But just a point of caution here, if we get a big adjustment in the fed market, there's obviously a big correlation here between your bred cattle market as well as your steer calf market. There's also a similar correlation between the bred cows and your fed steer market. So if we were to say, get that adjustment of instead of a 230 or a 240 fat market, we go back to a $2 fat market, I would anticipate that you'd probably have a little bit more weakness and end up somewhere in the mid threes on the bred cattle market. Relative to our cull cows, those continue to be exceptionally strong as well. This one, honestly, this stage part of our markets impressed me the most, just because we have continued to bring in an immense amount of imports, and yet our domestic import supply, or domestic lean supply rather, has continued to perform exceptionally well. Record prices into 24 and 25, and really virtually no break seasonally as we've come through the second half of the year. And we're starting off here at near record levels at $1.60. At the same time, when I'm looking at the cull cow market, I'm very focused on 90 lean trimming, our domestic 90 lean trimming price, because these cull cows are really the key source of that. We're not expecting to make really meaningful new highs in the 90s market this year. We think there's going to be resistance at that 440 level. Have they continued to perform very well? Absolutely. Even despite the imports that Matt's shown us that we've brought in and at record levels, you've continued to see record 90s prices in both 24, 25, and 2026. That really is a reflection of the demand for lean product. We need that product in order to fill the ground beef demand for the U.S. And so you've continued to see exceptional price levels, and that has also benefited the cull cow market as well. I think just to kind of show how they move in tandem from a big picture standpoint, you see a similar type of action back there in 14, 15 as well. The 90s go up, the cull cow prices go up. So to me, one of our big bellwethers for this cycle is going to be this 90 lean market. If we were to see a violation of this 380 spot right there, 380 per hundredweight, to me, that'd be a caution flag to us, because it likely tells us that either demand is shifting or we're maybe starting to harvest a few more cows and that potentially impacts the value of a lot of other aspects of our markets, one being the cull cows, as well as our cutout, and spills into the fed cattle as well. Ultimately, as we kind of look at the expectation going into 25 or going into 26 and 2027, in our opinion, we've kind of reached the peak in this cattle cycle. From 2020 to 2025 and 2026, just standard thinking about the typically 5 years, 4 to 5 years to the upside, 5 to 6 years to the downside would put both 25 as a candidate year. Because this cycle is a lot slower, I think you can extend it into 2026, just because we're not expanding nearly at the rate that we were during that 14-15 timeframe. All the same, even if 26 is the peak, we don't expect it to be anything like this to the downside. We expect a more moderate decline. Say we come back to $2 on our fats, maybe eventually getting back towards $3 as major support for your stocker steer, or your feeder steer, excuse me, and kind of back into that mid $3 area for your calf or for the cutout, and back towards $4 to the upper $3 for calves as we roll this cycle over. In our opinion, that's kind of, as we get into 27, 2028, kind of the shape. I think it's important to look back at history and just kind of see that rhythm in play. And there's two things that are very different, right? As we think about beef demand, we've done an exceptional job as an industry growing demand from the late 90s to today, and that's rewarded us in terms of the margin that we've created and been able to especially see on the cattle side of the industry during this cycle. But at the same time, most of these cycles are about 4 to 5 years, but when we look at them both to the upside and about 5 to 6 years to the downside. So we know we have some risks to this market that could potentially make an adjustment where we do go back to that lower $2 area, at least on fats eventually. I don't think long term that this is as much of a risk that we come all the way back to those levels. Could by 2030 you end up there by 170 or 180. To me, that's maybe longer term support or a better look at long term support, especially the key is that demand growth. We continue to grow demand as an industry, even as supplies turn, we'll have higher highs and higher lows. And that's why it's such an important piece to continue to invest in the quality of cattle that we're raising and the end product that we're providing for the producer. When we look at things and see that translate profitability wise, again, that's been the driver. As we've grown demand from being a demand destruction or losing demand, I should say, as we went through the 80s and into the late 90s, we didn't have a lot of margin to share as an industry across the segments. But as we became more and more demand focused and attained the levels of demand that we're seeing today, it's been an absolute game changer for our industry in terms of the dollars per head that we're averaging in margin. And rightfully so right now, where we are, the lion's share of that is going to the cow-calf producer. And that is a signal to us, the industry sending, that we are in need of expansion of that cow-calf herd. So hopefully the weather starts to allow that, helps to facilitate that. But that's been a big difference in terms of the demand growth, has been a big difference in terms of the margin available to our industry as a whole. As we kind of wrap up against the hour here, if you just take a little bit of time left, we do have our cow-calf survey coming out here here pretty quickly. If you would go to CattleFax.com in the About tab, you can access that survey. We glean a lot of valuable information off that and utilize that in terms of what's going on at the cow-calf level as well. If you'll be joining us in Nashville here in February, we'd love for you to swing by the booth. We'll also be doing a global protein outlook on the 5th there as well. And then please join us for the next webinar. Will be scheduled for May 20th, 2026. With that, we also wanted to share our emails here. If you don't get a chance or don't get your question answered, please feel free to reach out to us anytime. And then Matt will have this up, you said, in the next 24 to 48 hours, and it'll be available for free on YouTube there.